Hello, thank you for watching this webinar recording, where we discuss the FCA Consultation paper CP24/12, which proposes new rules for companies seeking to list on UK regulated markets and why we believe it is important for investors to respond. My name is Piotr and I'm part of the events and communications team here at Carbon Tracker. And if you want to download the accompanying slides, you can do so via the QR code on screen now. The original recording was split into two segments, with the first part a presentation, followed by a lively and dynamic question and answer session. Any questions that weren't answered during the event were followed up with as well. The webinar is a collaboration between Carbon Tracker and Client Earth, the latter of which is a leading environmental law charity that uses the law to bring about systemic change to protect the Earth. The presentation section was given by Mark Campanale, founder and director of Carbon Tracker, and Megan Clay from Client Earth, where she specialises in driving greater integration and disclosure of climate-related financial risks into investment decision-making. Joining Meg and Mark to answer any questions you had were Natasha Landell-Mills, partner of Head and Stewardship at Saracen & Partners, a global investment manager investing thematically on behalf of charities, private events, institutions, and investment professionals, and Sefi Roshan, a senior analyst in the accounting, audit, and disclosure team at Carbon Tracker. Moreover, our colleague Richard Folland, head of our policy and engagement, was here to moderate the questions during the second half. Due to technical issues, there were adjustments made to some of the visuals on this presentation, but we hope you find the content and discussion of value. Now, on to Mark.
So thanks, everybody. I'm pleased you're able to join us. I know some of you will be dialing in on the recording. Why don't I just cover some of the basic points in the presentation as to why we're looking at this with Client Earth. And I just want to briefly take you back to where this started, which was during the IPO of what was called Xstrata, now called Glencore, where in the 300 pages of the prospectus, there was only a few lines where climate risk was addressed, even though their primary activity is coal. So this has persisted since the last 20 back years or so. And what this consultation is trying to address is how can we properly incorporate the Paris Climate Agreement, the financial risks associated with developing fossil fuel reserves. How can we properly incorporate those in the documents that come to market for investors to consider when assessing whether to buy securities? We're looking primarily at the equity market, but the same issues also apply to the bond market. So this is the specific details of the consultation. Hopefully, most of you have been able to download it from Carbon Tracker's website or from the FCA directly. And then there's two specific parts to the consultations, 6.46, that we want to draw your attention to. Deadline, 18th of October, so about a month's time, and we're here to help you go through some of the questions and answers that you may want to submit to the FCA. Next slide, please, Piotr. Thanks. So the context of this is, and I think probably most of you know this, is that as the UK is leaving the EU, the old prospectus regulation that applied in the UK, which was the EU prospectus regulation, we are repatriating that into the UK. And so this is part of the attempt, well, the goal of bringing completely new prospectus rules into the UK to reflect UK interests. And that's really what the consultation is about. This bit about sustainability and about fossil fuel reserves and issuers from the mineral and mining sector, oil and gas sector, is only really a small part of this overall consultation. Next slide. So what is it that we're trying to address? Now, in the prospectus that companies use when issuing securities, there's typically what's called the competent persons report. It's an independent assessment that's completed by a qualified professional. It could be a mining engineer, it could be in the case of oil and gas, could be a petroleum engineer. They look at the planned projects that a company intends to develop, which is typically what the capital being raised is used for. And they produce this independent assessment of the assets, values, and associated risks in developing those assets. And of course, these assets could stretch out 10, 15, 20 or more years. And the competent persons report, and in the US, there's something called the qualifying persons report, which is very much the same. So the competent persons report just performs these basic functions. It's to build investor confidence. Here's an independent assessment of what the reserves are. It's to ensure compliance because, of course, there's a lot of regulation around public listings and particularly around minerals and oil and gas. You've got to get the technical assessments of that right. It's also to manage risks. So what are the risks in individual projects? And if you've not read one before, there's a link to below, which is Capricorn Energy. It's part of a deal with Cairn Energy, and in came the independent advisors. You can download this easily. Runs to about 200 pages. It goes through project after project after project, the geology, the risks issues, and it's part. It's an important document. What we've observed is that when you read these documents, there's nothing in there about any need for those projects to be consistent with our international obligations under the Paris Agreement. They're there to promote transparency, and of course, and this is where the financial case comes in, to provide and ensure accurate valuation with reliable data. So there it stands, and there are various other documents that sit with it, but the main point of it is to give investors confidence that the geology, the projects are described accurately. On to the next slide, please. Thanks, Piotr. Okay. So there, as sort of explained, there's no requirement, as it currently stands, for the competent person's report to be tested against the remaining carbon budget, or to look at demand scenarios consistent with the Paris climate goals. Now, I think a lay person's reading of the disclosures that they currently stand would lead people to expect these issues to be addressed. What we're really saying to here in the consultation is, look, let's make this explicit. Because investors are unnecessarily exposed to risks of losses due to an overstatement, potentially of profit and dividend potential, because of an overestimation of the realizable value of the reserves, leading to a possible potential stranded fossil fuel reserve assets, and an underestimation of depreciation charges on capital items such as drilling rigs, pipelines, and mining equipment. So, for example, if under these scenarios, reserves are not consistent with our international obligations, it could be that we would expect things like asset retirement of rigs, pipelines, etc., to be brought forward. And so this purpose really of amending the competent person's report is to allow investors to look at the transition and think about how these items change. Next slide, please. Thanks. I'm handing over to Seppi for this. Seppi.
Great. Thanks so much, Mark. So why is this relevant? Well, this is relevant because there's other disclosures in relation to reserves that are being currently considered. So the International Sustainability Standards Board is looking at enhancing the SASB industry standards, including specific disclosures, and that's going to be exposed in the first half of 2025. And we obviously encourage all of you to also look at the implications that that will have for disclosure and transparency. And the ISSB will also collaborate with the International Accounting Standards Board, because what they need to do also is to strengthen the connection between information in the financial statements, but also other parts of the financial reports. And this is why this particular issue that we're looking at, the FCA disclosures and the competent persons regime, is extremely important, because the information will inevitably flow into the financial reports when we're looking at these reserves. From the IASB side, just a note to say that they will not be doing any further work, because they've already looked at extractive industries from a financial reporting point of view. But as I mentioned, it's extremely important that they remain connected with the work of the ISSB to ensure that the appropriate disclosures are made, and that it gives visibility of how that information is flowing into financial statements. Thanks, Mark. Next slide.
So here's the proposal. We're proposing the introduction of this further financial feasibility test in the form of what we're calling an atmospheric viability test. It's, are the reserves in the ground that you've found, is there space in the atmosphere once burned, i.e. does it fit within the remaining carbon budget or the Paris Climate Agreement? So this will go into the competent persons report for mineral companies, including those in mining and oil and gas. Okay, so how do we apply it? That's the next slide. Thanks, Piotr. Great. So those of you who follow Carbon Tracker's work will be familiar with this. What you want to look at on the left is a supply curve. And this dark blue line represents tens of thousands of projects, this is in the case of oil and gas, going out into the future. And along the bottom, which is where you need to look at, this is the cumulative supply from your oil fields in millions of barrels a day. And what we've done here is we've looked at different scenarios, the announced policy scenario, the stated policy scenario, and we've intersected the supply curve with supply that's consistent within those scenarios. And then you can put a price point on it. So everything between 0 and that intersection APS is consistent with the announced policy scenario. And then you can go over to the blue, the stated policy scenario. For those interested in IEA 1.5 net zero, it's not on there for the simple reason that, of course, no new supply, according to the IEA, is consistent with the IEA 1.5 scenario for conventional projects. Now, on the right, this is how Carbon Tracker has applied it in practice. It's a bit small, but you can download this from Carbon Tracker's website and from our reports. You'll see there lists of companies. These are their potential projects and capex under different scenarios. And the point to be made there is, as you can see in the red, significant amount of capex by these different listed companies is inconsistent with the stated policy scenarios, i.e. it's way beyond what we've signed up to under international climate agreements. And so what the atmospheric viability stress test actually does is looks at individual companies' planned reserves and capex to test what percentage or proportion of it is consistent with those different scenarios or the different climate goals set out. So because we can apply price test, what we hope will happen is that companies will report against different break-even bands. They won't tell detailed projects, but we can say what percentage of planned projects, say 40% is consistent with a price band of, say, between $30 and $40 a barrel and so on. And that will give some insight into investors. So if you've got projects that are breaking even above $60 a barrel, it's another way of telling investors, look, these projects are not consistent with the Paris goals and are outside of the different carbon budgets. Thanks. On to the next slide, Piotr, please. Great. So why does this matter? For the investor, this is just another way of presenting discounted cash flows from future years and allows you to come up with the value of the business. So if you are trying to calculate future revenues out into the, going out 5, 10, 15 years, by applying a climate test, you can say, well, actually only 7 years of reserves are consistent with our commitment to a net zero scenario. So we just change the way we discount these cash flows. Now, typically in the case of oil and gas, cash flows are discounted over a very narrow short-term period anyway, but this just adds some belts and braces to allow an analyst providing their own calculations as to the value of companies. Now, I think this is something we've said before with Carbon Tracker. There's around $110 trillion of future value from the reserves of listed companies. You calculate that by taking all the barrels of oil, gas, and cubic meters of gas and tons of coal and just taking the market price. And of course, that doesn't give you the market cap value of those companies. It's a tiny fraction of that. But that just illustrates the importance of the need to discount the future value of these reserves, much of which won't get produced under our Paris goals. Next slide. So I'd like to hand back to the other speakers to pick up on this, and perhaps Megan, you can give your thoughts on where we go to next from here.
Thanks very much, Mark. That was beautifully put, and a really nice summary for everyone, hopefully. Yeah, I guess perhaps just for me to add in a little bit about why as Client Earth we see this as a real priority area. It's an area we've been interested in for some time, because ultimately, since the FCA has introduced TCFD-aligned disclosures for listed companies, the point of listing, which is what we're talking about today and what we've been discussing in terms of requirements for the prospectus, has been a bit of a blind spot. So listed companies have had to make disclosures once they were listed, but not at this point of listing, which has really meant that at the very point that investors are buying in, they don't have this critical information. And I think at a high level, we see this point of listing as a critical point in the life cycle of a company where it's first coming to market. And that seems even more pertinent where, of course, the government has been talking about a net zero financial system. So in that context, it's critically important that we look closely at the role of the financial markets and the point at which companies list there. And ultimately, this and very similar issues here are what led us to judicially review the FCA's decision to approve the prospectus of Ithaca Energy. So this was back in 2022. Ithaca was the largest listing in that year. It's obviously a pure play North Sea oil and gas company. But in our view, their prospectus and the disclosures within that didn't meet the standards expected by the regulation in order to give investors the information that they needed. And the proposals that we're talking about today, we really feel would go a long way to addressing that, because what we see at the moment and what we saw in that Ithaca prospectus was that there are disclosures, broad disclosures, high-level disclosures about the materiality of climate change in the back end of the prospectus. But, and as Seppi alluded to, those just don't translate through into some of the accounts, but also they're not translating through into the competent persons report. So we see this as a real blind spot, something that's climate blind, as I guess we've been saying. So really important matter, and super pleased that so many of you are here today to find out a bit more about it.
Thanks. So investors can download documents off the website. You've got the QR codes, and here is some summary rationales behind it. One is enhanced price discovery, better capital allocation, enhanced capital allocation, better investor protections. Thanks. Of course, to support market integrity and effectiveness, and to align with the UK's net zero targets and the UK Climate Act. So we do encourage people to respond to the FCA. We're often asked about regulatory arbitrage. Will this force companies to move elsewhere? We think that standard setters who would work on this would come up with similar types of disclosures that would also apply in markets elsewhere, the obvious ones being the EU and North America. Thanks. Piotr, or Richard? Thanks.
Yeah, I think Mark, thanks very much for that, and to Megan and to Seppi as well. And I wonder, Natasha, if I could bring you in, please, with a question. Perhaps if you could give us a perspective from an investment manager like Saracen.
Yeah, I mean, look, I'm just echoing really what has been said during that very clear presentation. I think, in the end, this is all about investor protection. And what I would say is that is at two levels, and I think most people on this call will be familiar with that. But it's investor protection at the level of the individual company that's seeking to list its securities, because as we've heard, understanding what the potential exposures could be to a more rapidly decarbonizing world is very, very important. But also, secondly, at a kind of more macro level, it's important to investor protection, because the kind of incentives that come with better disclosure would help to ensure that less capital would be allocated towards these sorts of harmful activities, and more capital would be allocated to the solutions to climate change. And for long-term investors, obviously, then that has the kind of universal investor impact. And I do think it's important to underline both. This is not just about the individual company. This is about the question of efficient markets, efficient capital allocation, and making sure that we are providing the foundations for sustainable economic growth. And I think that should be front and center in any response to the FCA, because that is their remit. On the point about the broader backdrop for this consultation, which comes out loud and clear in the FCA's document, this is about, from their perspective, to a large extent, becoming more light touch. This is about reducing costs to issuers. There's much less emphasis on investor protection. So I think investor respondents to this consultation should be bringing that out and saying, look, it's in the end, for UK markets to be resilient and to continue to attract listings and to continue to attract investors who wish to invest through the London market, having these kind of disclosures is very, very important, because it ensures that investors can trust the information that they're getting to be able to deploy their capital wisely. So I think there's an added element in this consultation, which is to push back on this notion that this should all just be about lowering costs, because that will be good for the UK. If lowering costs means lower disclosures, less reliable information, ultimately that will be bad for the UK. So I wanted to just add that other point. And I think finally, if I may, the work that Client Earth and Carbon Tracker have done to get this into the consultation document is superb. So look, the hard graft of reaching out to FCA, making the case, has led to a very clear impact already. And I think now for investors to simply respond to the consultation and say, yes, please, this would be incredibly helpful for us, should be relatively easy, but vitally important. So let me just end on that point. Thank you.
Thank you, Natasha. I think both from your perspective, but also to come back to the question of the consultation in the end, and a reminder here that the deadline is 19 October still, so there is still plenty of time at the moment. So we now have some questions that have been coming in, and thank you very much for these. One or two which are quite detailed and technical, but I'm going to start with a question here from Josh Brewer, and perhaps Mark or Megan, you might want to respond to this. Who would you envisage providing the competent person opinion?
So just very quickly, dozens and dozens of companies already provide the competent person's report. So this would have to change. And we've made a submission to the two key standard setters, well, the main one for oil and gas being the Society of Petroleum Engineers through PRIMS, which is their performance metric for setting out what is an oil and gas reserve. So we've asked them to change the framework of how they consider what is a reserve. And you can find that submission, I think it's on our website, to contact us to find that. And we've also been talking to the POATRs, which develops the standard for coal and mining, and we've had meetings with them, and I presented at one of the POATRs conference webinars on this topic earlier this year. So the standard setters are crucial. They then in turn inform what the individual competent persons or the consultants actually do for what goes into the prospectus. In these teams, now if you take a consulting company like RPS Group, they've got 28,000 staff, not all of them doing competent persons report, but they've got a very good team doing it. You go to a different part of their website, and of course, they've got climate teams and sustainability teams. What we imagine happening in practice is that the team doing the competent persons report, probably from a very traditional geological, mining, or petroleum engineering background, would bring in somebody from the same company, or if it's a university, from a different department that had the skills in the atmospheric sciences, the climate sciences. Somebody could actually interpret what we know from the IPCC scenarios and the IEA scenarios around climate. So we don't doubt that the skills are there. We think that they are. We think that the industry is already set up to do assessments like this, because many, many advisory firms obviously compete to produce these technical reports. And it'll be just a matter of bringing folks at the end of the corridor in a department in to join your team as you actually prepare the report. Megan, I don't know if you wanted to add to that.
Thanks, Mark. No, not really. I think just to overlay that the standard setters are kind of set out already in the FCA rules. So the FCA specifies relevant standard setters who in turn put in place those standards that Mark was talking about. And then, as Mark says, there are various companies that already provide these competent persons and provide the reports. So in terms of those organisations needing to upskill, I think that's definitely something that they would need to do in order to adequately be assessing the atmospheric viability test as we've framed it. I think many of the standard setters also need to upskill to bring themselves up to speed with climate change and its impacts on the industry and on the competent persons report. And I suppose it's worth noting at this point that under the requirements of the competent persons report, it's already arguable that this should already that some assessment of the context of climate change should already be required. It's just that in practice we don't see that happening. I guess that's a slight digression. I suppose the key point is really same companies will be providing these reports, just a matter of bringing in additional expertise in order to adequately opine on these matters.
Just to add to that, to your point, Megan, I think what this is really about is incorporating an IEA type-based stress test. It could be a different scenario, it could be an IPCC scenario. And under the IEA, you've got a choice of scenarios. You've got an IEA 1.5 net zero, which many investors would want to see a stress test against, or it could be the stated policy scenario. So we're not specifying, saying you've got to do one scenario, not another. I mean, my preference is to have two scenarios, an optimistic one and a pessimistic one, to allow investors to see the range and see which projects are consistent with both ends of those scenarios. One being, you need more projects, one being you need significantly less. And so the competent persons report would try and attempt to bring the IEA scenarios into the competent persons report that goes to investors. Thanks.
Thank you, Mark. And I can see that. I think you were picking up on Fergus Green's question here.
Oh, right.
About the scenarios.
Oh no, I've not seen that question.
Oh, right. Well, there we are.
Which
he asked a question about what scenarios we would envisage being used for the atmospheric viability test. Yeah. But so thank you. And I think you covered that.
Just to be clear on this one, Richard, is that we know within the industry, and for example, the OPEC doesn't particularly like IEA scenarios, and so we wouldn't be surprised if reporting entities would use a completely different body. I mean, our preference is for one that allows for comparability, which is why we like IEA.
Sure.
But we wouldn't be surprised if the industry would say, okay, we're not going to use any of those scenarios. We're going to use our own because they have their own modelling teams. But if we go down that route, we're going to have a lot of non-similar, incomparable type scenarios, which will be very confusing. So we hope the FCA and investors will give their views on some recommended scenarios that reserves can be tested against.
Understood. Thank you, Mark. Fergus, I hope that answers your question to some extent, but we will pick up with you separately. Now, there's been a couple of questions from Brendan Devlin of the European Commission. I'd like to come back to those. But
I'm so sorry. Natasha, I'm so sorry to interrupt, but I thought I'd just add very, very briefly on that final point, because and it's a bit weird to be a bit more radical than the NGOs, but I do think actually investors need to be asking for a Paris-aligned scenario, and that's because not only is it consistent with UK government's statutory commitments and the Paris Agreement, but for many investors now who are signatories to NZAM or whatever, we need this information to fulfill our own commitment. So I think there's a very strong set of reasons for investors to say that, we need to have hothouse worlds, but also we need to have something that's Paris aligned. Thanks.
Great. So Seppi, yes, you wanted to come in, I think, on the question about scenarios as well.
Yeah, fabulous. Not so much about the scenarios, but about the competent persons report. Sure. I think we need to step back and look at the broader implications for this. While this is a very specific issue that we're talking about, I think what it underlies is this idea that we want to mainstream consideration of climate-related risks in the work of these experts that then flows into much of the financial decision-making that occurs and identification of financial risk in this particular sector. I think it's extremely important, for example, when auditors use the work of experts to make sure that this information about climate-related considerations has flowed through, so that it's not necessarily a get out where you can say, well, the expert did it and they didn't have to consider climate. When we're looking at auditing financial statements, or the preparers say, when we're looking at our cash flows and the implications, we defer to the competent person. They're the experts. They understand things about reserve viability. And so it means that we don't necessarily need to consider these other items. So I think there's a broader issue here, and taking that perspective then actually increases the critical nature of responding to this particular issue and the urgency with which that transparency is needed in order to look at the whole reporting ecosystem and the implications of introducing such a test. Thank you.
Thank you, Seppi. So, I'd like to turn. There have been 2 or 3 questions here about stakeholder engagement and consultation. Okay, well, one is about developments in UK law and EU markets. For example, the EIA directive. I don't know if there's anything we can say on that, but also Brendan Devlin has asked about the position of the USA SEC. So, Mark, if you want to think about that as well. But in the meantime, questions here. So from Harry Ashman, from Raj Singh, any sense that we have how industry is responding to this proposal, whether we're talking about finance and investment, whether we're talking about oil and gas trade bodies as well. Then from Helen Wiggs, have we taken these findings to any potential future book runners? Do we think investment banking departments may still lack expertise to take these considerations into account? And there was another question as well. Have we consulted the industry on these changes? Mark, Megan, or anybody else? Yeah.
I mean, since the beginning with Carbon Tracker, it's over 12 years old now. We've been making our case to the regulators, to investors, and to companies of the need to make these disclosures. It's really only since the Prospectus Consultation has appeared that we actually have the chance to address this issue directly. So from a Carbon Tracker point of view, I think we've been very clear from day one. If you read our very first report, we actually talk about the need to amend prospectus disclosures and to get the accounting treatment of fossil fuel reserves right. Now, when it comes to the companies, we have talked to the companies on multiple occasions asking them to disclose the embedded carbon dioxide in their reserves and then to stress test this against the remaining carbon budget. And I regret to say, Richard, and I think you may have even been in some of the meetings, they've all said no. Even the trade bodies, they said we completely support transparency, just not this kind of transparency. So as we imagine we need to sort of tickle them under the chin a little bit more to persuade them of the materiality and usefulness of this. I can't say whether they will be explicitly opposing these disclosures at a time now when I think the financial markets need to price securities right and correctly and get the material information into the market, as Natasha's argued. So we'll have to wait and see how the industry itself is responding. I would just quickly pick up on the SEC.
Yeah.
Now, the SEC is going down, I think most of us knows about this. They're going down the route of Scope 3 emissions, and they've created a lot of sort of backing into a corner type thing with them asking producers of fossil fuels to report on their Scope 3 emissions. I think it's a bit of a dead end. I think what should really have happened is companies that are bringing reserves to the market should be disclosing the carbon dioxide in the reserves as a forward-looking indicator of what emissions are likely to be from their assets. And so actually amending the prospectus regulations and in the US, the qualifying persons regime would actually probably address investor concerns and interests around Scope 3 reporting. Now, we actually submitted evidence to FASB, the Financial Accounting Standards Board, back in 2013, where we made the case to the FASB that fossil fuel companies should be disclosing the embedded CO2 in the reserves. I'm afraid it went to a vote and it didn't happen. We do need to pick up on that. I should imagine that IOSCO, which has its climate working group, will open a discussion if this regulation is passed in the UK to see how it might apply to other jurisdictions. And our goal here is a global change to international standards through Frisco, the Global International Standards Boards, that includes the oil and gas industry and the mining industry, that they will develop some standards that apply internationally, so covering Australia, South Africa, Canada, and the US, as well as Europe and the UK. So our goal ultimately is to have what we think is a very common sense proposal adopted globally through changing how the global standards setters think and work, and also alongside it, how the accounting standards boards actually work on disclosures around reserves. I think there's probably more questions that remain unanswered there, Richard. But back to you.
No, but thank you, Mark, for picking up on that sort of overall point about differing jurisdictions. And Brendan, we will come back to your questions about European law as well. We'll follow up that with you offline. Megan, I wanted to turn to you because I know we've talked a lot about equities here, but also the question, what about debt? And there is a question here from Beth Burks. Is there anything that is specific to labelled issuance, green bonds and the like? Would you like to pick up that one?
Yeah, absolutely. Thanks, Richard, and thanks, Beth, for your question. So debt, in terms of the competent persons report, there isn't currently a requirement in the existing regime that competent persons reports are required for new debt issuances. And more broadly in this consultation, the FCA has taken the approach that its proposals are relevant in relation to equities, but that it doesn't intend to apply them to debt because, well, for various reasons, including that some of those issuers are more diverse, these matters may not be relevant for them. I think, and this comes back to the fact that we're hosting this webinar and really hoping that investors will respond to the consultation, because I think, and I know from talking to various investors on the debt side, on the bond side, that actually these matters are really relevant to them. And I think it's really important that the point is made to the FCA in the context of this consultation, that actually this is something that is relevant for debt prospectuses. And I think, particularly in the context of the competent persons report, where this is a regime that applies to specialist issuers. So when we look at the oil and gas sector, for example, climate is clearly very material for these issuers. And so from my perspective, it seems like there is a clear argument that that disclosures along the lines that we've discussed in relation to the competent persons report, this atmospheric viability test or similar, should equally be required on the debt side. And I think there's a question about how the FCA might want to do that, whether that would be perhaps incorporation by reference to try and make it a slightly lighter requirement on the debt side. But I think super helpful if respondents to the consultation can make that point. In terms of the more specialist instruments, so the green bonds and SLBs and so on, well, I guess my previous answer probably applies. So the competent persons report is not something that would be particularly relevant there. More broadly in this consultation, there are proposals in relation to specialist bonds that the FCA is consulting on. So I won't go into that here because I don't think we've got time. But do have a read of the consultation if you're interested in that.
Richard, just to emphasise the importance of this. Just in July, Saudi Aramco in the London market issued $6 billion of bonds in what they call their global medium-term bond issuance. And a good proportion of those bonds were dated 2064. Now, if that's their medium-term note program, I'd hate to see what their long-term note program look like. 2064 rather does seem a long way out to achieving our net zero goals. And should we really be issuing bonds for fossil fuel development dated 2064, knowing that we need to be well off the use of most oil and gas and coal well before 2064? That's why Megan's point is so important, that we need to get these disclosures properly into bond prospectuses as well as equity prospectuses.
Excellent. Yeah, that's a point well made, Mark, and pretty sobering as well, that Aramco should be thinking in those terms. I've got a couple of questions here that, Natasha, I might turn to you on this, actually. One from Harry Ashman says, great, this has been considered for new listings. Are there plans to bring the question of an atmospheric viability test to the rules affecting already listed companies? Wondering if you might have a view on this. And,
I think this is one for SEPI, because I think the regulation will back through into accounts reporting, and but maybe Natasha as well.
Well,
yeah. I'll let Natasha go because you directed it to her, but I'm happy to jump in after that.
Sure. But maybe if I can couple this with something related from Louisa Guy, for Natasha Seppi or Mark, you might have a view. How does this proposal square with pushback about sort of reporting requirements and so on as well? Maybe Natasha, to you first.
Yeah, so very happy to offer a few thoughts on that. So I think this is incredibly complementary to all the work that many investors have been involved with alongside us as well, pushing for greater disclosure within existing financial statements of how material climate-related risks have been considered. And most notably, that's going to be affecting impairment testing, AROs, et cetera, et cetera. So this has been a very long-standing area of work. Carbon Track has obviously been doing a lot on this as well. So I think that this complements that work. And actually, I think it was Megan who said at the beginning, the point is that listed companies are already starting to get or already getting guidance, for example, from the FRC, Financial Reporting Council, on making sure that under existing financial disclosure rules, they need to be considering climate risk, whereas you don't have a commensurate set of guidance for IPOs. So I think, if anything, where we are now, and we're not perfect, we've got clarity from the regulator on the need to include material climate risks within financial statements, but you have nothing on the IPO side. So this would kind of bring those into better balance. Because the last thing you want to do is deploy capital into an entity and then they produce the financial statements and say, well, actually, there's a whole lot of capital at risk, and you would quite rightly be annoyed. So I think that's just a really important aspect of it. I was going to just mention, if I may, on the SEC side, that despite the climate disclosure rule being stayed, we have, and I'm hoping there's mostly investors on this call, but we have a draft letter where we're building signatories for going to the SEC to point out that under the existing regulatory architecture, so Reg SK item 303 to be specific, there are already rules on the need to disclose your forward-looking critical accounting assumptions. And where there are particular uncertainties, like structural change in an industry, which you do have, affecting the energy industry, for example, that companies should be providing sensitivities to those forward-looking critical accounting assumptions. So within the existing architecture in the US, whether or not that climate disclosure rule is stayed, there are already clear requirements in our view that this kind of information should be being published. I won't go into kind of the details on how those forward-looking assumptions circle back to this, but essentially it is all intertwined, because once you think about your decarbonization situation, those assumptions will be affected, and that's how it comes together. But so I think that's just to mention that as well. And Richard, I don't know if there was another point, but
there was one about, is this all over regulation and over reporting?
Yeah,
I think that, and Natasha, I'll be interested in your views on this as well. I think that sometimes there's too much sustainability reporting that is not material. Or requires whole new groups of people coming in to do the work. I think the point we'd make about this is that we already have standards here within the competent persons rule. We already have professionals producing huge reports. All we're simply doing is saying, get skilled up to do the real analysis here, which is whether the reserves are consistent. So it's not, we don't see this as onerous. We see this as just additional to something you already have to do. And really ought to have done, and making explicit by the regulator to companies is produce this information is really very timely now. So we don't see this as burdensome, nor do we see this as excessive. And some types of reporting, which we know there's a lot of pushback against, don't have the same kinds of substance or materiality that this revision would have. I don't know, Natasha, whether you're a fan of all these other bits of disclosures that companies are trying to come up with, but I think this is just a course correction of what companies are already having to do.
I think that's right, Mark. And just to jump in ahead of Natasha, I'd also make the point that what we're suggesting in terms of the competent persons report is really fixing what's there already. Because exactly. The real issue is that the existing CPR, given that it is climate blind, as we're framing it, is doing harm, really, because it's misrepresenting the situation. We know that in practice, climate just isn't being considered, and that's a real oversight.
Good. Thanks, Megan. We don't have long left now, and there's still two questions I want to get to, but also I just wanted to give Seppi the opportunity to respond as well on the disclosure point. And then, Mark, there's a question for you, if you can come to that after that, on the role of investment consultants, going back to loading the dice work. And then there's a great final question for all of you, which I want to finish on, from Joel Lee. But first, Seppi.
Brilliant. Thanks so much, Richard, and thanks so much, Natasha, Mark and Megan, for your comments. I guess what I'd like to add to that is really transparency is key in markets that we want to trust and that has, integrity, so that we can maintain that stability. Essentially what we're saying is, instead of sitting there trying to guess if the competent person and these experts that are, all the information that underlies our capital allocation decisions, whether it's in the prospectus or eventually will feed into the financial statements if we don't stop it at that point in terms of the decision making, will, instead of guessing, we're asking for that transparency. So the IPO portion is to say that transparency occurs before you lay your cash across the table and allocate it to these projects that are potentially going to bring risk onto balance sheets, but also really ignore possible avoidable emissions, which is really important. Then the other part of it is that if it does get through that process because of either of a lack of transparency or because the information is ignored or whatever reason from the market, then that information from the competent person will inevitably flow into the financial statements, as Natasha mentioned, because it affects cash flows, which then gives us an idea of also through the estimated remaining life of the reserve, which is something that feeds into the cash flow estimations of related assets, the value of the minerals, or the oil or the reserves. It all feeds into that decision-making process. It also feeds into overstatement potentially of financial performance. If we're using a competent person's estimation of, for example, a useful life of a mine or a reserve, and we're saying, well, actually, it's longer than we expect it to be. The depreciation charge might be underestimated. The profits might look bigger than they would otherwise do. And it distorts the reality of the market when we put that material climate-related risk overlay. So really, it's, as I mentioned before, it's looking at the broader implications and mainstreaming it. So no, it's not a burdensome, because it's all about transparency and making sure that the markets are working efficiently.
Great. Thank you, Seppi, and for bringing it back to the financial statements. So, Mark, I'm going to give you 30 seconds on the role of investment consultants, and then I'm going to turn to each of you in turn. It's a great concluding question, I think, from Joel Lee. Just for your quick assessment as a panelist, how far will the impact go of what's being proposed, given sustainability-minded investors would have excluded fossil fuels already, and those that invest in fossil fuels would probably not be too interested in the remaining carbon budget? Really good sort of overarching question. So if each of you can think about that. But Mark, the role of investment consultants, when are they going to take into account climate science?
So, look, let's be clear about this. What the investment consultants do when you select fund managers, you can remember I was worked in the fund management industry for 20 years. What the investment consultants are doing is picking managers that they think know how to properly assess risk and properly value securities. So they expect fund managers to properly discount the non-viability of some of these business models that we see in the fossil fuel companies. I don't think because the market information isn't there, fund managers really can't see the limits of what these companies can potentially do with their reserves. So these changes we're recommending will actually enable fund managers to do their jobs better, and hopefully investment consultants will pick better fund managers who are better analysts. And that's really where this feeds back into their duty. Part of the reason why they're getting climate risk models wrong, as we know, is because they think that 3 degrees is not going to impact on asset values. And that's why they don't particularly care whether pension funds hold fossil fuel companies that are not consistent in their plans with Paris goals. A lot of this will change, Richard, if this regulation is implemented next year.
Okay, great. Thank you, Mark. So it's going to be rattled through very quickly now. Maybe Natasha, impact of this proposal. Investors who are progressive, but those who aren't progressive. Any quick final thought here?
Yeah, I've written three points down. This is about bolstering market efficiency, protecting investors, and ultimately protecting the planet. So I think what this is about is dealing with a market failure that will ultimately undermine financial returns and economic growth.
Great summary, Natasha, and that's consistent with those messages at the end of the presentation. Seppi, any quick final response from you here on the impact of this proposal?
Sorry, Richard. Thank you. Yes, look, I think it's also a question of governance. What's happening in terms of where projects and capital is being allocated within companies? Why is there continued focus on projects such as, more reserves when we know that the viability of these from a climate perspective is low? So I think it also gives investors the right to turn around and say, well, actually, what are you doing with funds already sitting that we've already invested, let alone, so for those of the companies who are already listed, but why then bring into the market a company whose governance over such matters is open to question?
Very good. Thanks, Seppi. Megan?
I think it's super important for all the reasons that the other panelists have mentioned. And I think ultimately it's really about bringing the numbers around these reserves and their extractability, their viability to the fore for these companies. Thanks.
Thank you, Megan. Mark, the final word with you on this.
Look, just to encourage investors here to download the materials, look at the draft template letter, and get in touch with the FCA. This is really down to the FCA listening to the voices of investors, not to specialists like Carbon Tracker. So please do express your voice.
Thank you, Marco, for that concluding point. And we are here to help, as Mark said in the presentation. So please do follow up with us. And just to thank our panelists, thank you for your attention, and Piotr and the team for putting this on. Thanks again.
Thanks, everyone.
Fabulous. Thank you.
Thank you. Bye-bye.
Bye.